It's the day. So we've been waiting on this for quite a while. It is turning out to be one of the most pivotal and influential FOMC meetings in this decade. Of course, it's still a young decade to be sure, but it sounds pretty good, doesn't it? I think everybody has reached the consensus that it's going to be 75 points. And as I've mentioned before, when everybody thinks they have it all figured out, that's when I start to get just a little bit nervous. So the assumption, you know what happens when we assume? The assumption is 75 points. Should we get something other than that? The market will react very violently. If it's 100 basis points, we're going to go down like a brick in water. And if it's 50, then we're going to go up like one of those SpaceX vehicles. So as I've mentioned before, one of the things that you want to look at through the day is this FOMC Fed Watch tool, and just come down to the bottom and see if the changes are drastic. That's how you'll know that they're kind of done pricing things in. Now after today, we're going to get a lot more information, and we're going to expect a lot of these to change. Right now, the ones that are grayed out across the top, those are not set in stone yet for the date. Right, that's why they're grayed. They could be adjusted. The ones that are solid white, those dates are set. So we're not seeing a lot of movement here, which makes perfect sense. Everybody at this point is just looking for the outcome first. So like we do every morning, we want to start with what's going on around the world. Last night, Putin addressed the nation, and obviously not our nation. There could be an entirely new phase to this war coming in. So that's certainly something to keep track of. We have the president speaking possibly at the UN today. And we have crude inventories today. When it comes to crude, continue to keep track of hurricanes in the Gulf. I haven't heard about Fiona in a little bit, so I'm not sure if it dissipated or what. There is a currency war going on right now, and that is also one of the things that are kind of battling everything out. I've adjusted the Twitter package. It's that Discord that I built for you guys that monitors Twitter feeds and then posts them into this Discord. Kind of got them broken down into different categories. I don't like going to Twitter. Using something like this just kind of weeds out all the noise, and it allows me to put, say, a particular person's tweets all in one spot without having to go get them. So I've made some adjustments in there, kind of added more fund managers, and made some adjustments. It's worth checking out. Alright, like we usually do, want to start with the volume, accumulated volume in the overnight hours, sitting at around 150. For the week, that doesn't seem to be out of line. We had 139 last Friday, 118, 132. So we're right in there. It takes seconds to just take a look at what's going on with the overnight volume. So you can see we haven't done anything all night, right? And yet the amount of volume that we have is comparable to earlier in this week. A lot of positioning getting set up. Once we take a look at that, see what we need to see. We don't really need to keep it around anymore. So take that one off. Let's take a moment. Come out to the higher time frame. This lower indicator right now is looking at the 10-day moving average and kind of asking that question, how far away from the 10 period moving average are we? I use this for a variety of things. One of them is to answer a question, have we moved too far, too fast? Because generally speaking, when we do that, we very often whip back the other direction like a person on a bungee cord who's stretched it out as far as it can go. Right? That's kind of the analogy behind it. So when you get too far away from the 10, price generally will pause there and let the 10 catch up, or it will revert back to the mean. It'll come back to the 10. Every market has its distance from 10, which is why I built this indicator. We can't just use some arbitrary number and say, well, when price gets more than 3% away, it's going to pause. That might be true for one company, but not true for another company. And then, futures are a completely different thing. ETFs, ETNs, double, triple leverage. It's an endless list. So with this indicator, just a quick visual, and you can kind of get an idea of, hey, have we moved too far? In 2022, this has been a really useful indicator because we get those really big moves this year. Right now, we're not out of line. We haven't moved too far. We're kind of just holding steady between 1 and 2% away from the 10 period daily moving average. So it has the capacity to make a good sized move today. We already knew with the volatility on the table from the FOMC that we're likely to get a move today. This shows that we're not overly extended to the downside, so the move to the downside could easily expand from here, a good 3%, and it wouldn't be out of line. And then of course for the upside, well, we're not above the 10 yet. So if we were to get bullish today, just getting to the 10 would bring us back to balance. And then, beyond that, a good 3 to 5%. I don't even look at it as a single day with this indicator. It's more of, say, within a week, right? Kind of counting back over the last 5 days or thinking about the next 5 days. Depending on where you learn to do analysis, some places really lean on that 10-week moving average. One place that comes to mind is Investors Business Daily. They really love that 10-week. And there's a reason behind that, right? I mean, they've spent countless millions of dollars developing books and webinars and video series, and they've talked about it until they're blue. They wouldn't hone in on it so much if it didn't have inherent value to them. Okay. We're sitting at a -3. At some point this year, we were down at a -8. So obviously, it can move lower. But we're right around where we would expect to see the market pause, turn, reverse, go back, because we're around that average distance to the downside from the 10. If we were to make a move to the upside today, we got all of our moving averages over our head. volatility will beat those. So, on a general, normal, everyday average kind of move, trying to get through daily and weekly moving averages that are over our head would be a challenge. In a volatility event, we'll just move through those like nothing. We are IX10 at this point, and of course inside day. At the very least, when you're dealing with any sort of a range, you can always measure a range. You can always measure a big candle, plot it out. 40.29 would be 100% of this range down here, and 50% of that would be 39.82. We're looking at the SPX right now, and this is a year-to-date chart. In white lines, I've got the FOMC marked out the day before and then the day of. I started to go in doing the CPI marks, but seen something shiny, got distracted. Come back later and put them in. I've got them in on my trading view chart. I just don't have them on my thinkorswim chart. I see questions all the time when we get near an FOMC that usually sounds something like, do we usually get a post FOMC run, or do we usually get a pre FOMC fade, or what's the market usually do after this? When you want to answer those questions, asking people in a chat room really isn't the way to get it done, right? First, you have to hope that they're smart enough to understand what the hell you're asking. Two, you have to actually be smart enough to put the words together to form an intelligent question so that other people know what the hell you're asking. You're better off just looking for those answers for yourself. It doesn't take a whole lot of work to go back and look at where was the FOMC before, mark it out, and then start answering your own questions. Did we get a rally? Did the rally fade out? Was it a one-day rally? Answer whatever questions you want to answer at that point. You'd be much better served doing your own work. If you want these dates, you can get them from Google. Literally just go to Google, start typing in when was FOMC, when was 2021, 2020. I mean, it's all there, right? It's all recorded. You can often find websites that correlate and quantify and measure and look at things like the average pre-run, the average after announcement movement. There's all kinds of material like that out there. So don't feel like you have to do it yourself. If you can find a PDF, a book, an article, speaking of those, there's a Google, but then there's this. This is Google Scholar. So if Google is the generic, we'll look around the world kind of thing, Google Scholar is what they call peer-reviewed or white paper articles. You can find absolutely anything in here. When it comes to the insider dealings on how volume is supposed to be published by a broker, for an example, this is where I learned a lot of that inside, not really inside, but the nerd side of things, where, and not just when was volume printed, but what's the law about how fast they have to print it, and how do you circumvent that law? So when the institutions want to hide from us, what recourse do they have? Right? There are all kinds of stuff out there. This is a really great resource. They're not always free. Right? It's going to show you an aggregate collection. So for an example, if I look at trading psychology. It is going to look around the world for any articles or PDFs or books or anything covered through colleges that matches what I'm looking for. Some of the links aren't going to be free, but a little tip: if you find the link on the side, those are often free. If you don't find a link on the side, like right here with this book, then it probably won't be free. Right, so maybe that'll help you out a little bit. We've had 2 runaway FOMCs this year, and then one that was just really nice and bullish, but it wasn't necessarily a runaway. March was the runaway, and June was the runaway, both in different directions, but still. And then there was the July one, but that one in July came after everything had changed. Like all the flows, all the market structure, the dynamics, breadth, everything changed before that FOMC. And this was just more of a continuation of what had happened back here. So I don't really attribute that run to that FOMC. But, whatever. There you go. Dig deep. Alright, so for today, we have every expectation of leaving the range after FOMC. Until FOMC, we have no expectations of leaving this range. We are inside day. We're sitting inside of yesterday's price. That is all we anticipate. It's all we expect all the way up until the FOMC. What I would encourage you to think about, for those of you looking beyond futures and thinking about stocks and options, is where are we looking to go in the between now and November, and then between November and December's FOMC. It's very likely that this next earnings cycle is going to start seeing some real negativity coming into the market. Earnings valuations are, one of those bubbles that need to be popped, and I've heard from people much smarter than me that it's what is expected this next earnings season. So you get this nice little window between now and the next FOMC to either continue a degrading move to the downside or get that explosive move back up again. Don't think of just today or the next 2 days, right? Not as the swing trader, but kind of think about that bigger picture. For the rest of us looking for some day trades, we should get some consistency after FOMC today. I mentioned yesterday that Barclays and I think it was Goldman are getting sued because they were caught manipulating the VIX. There's still a lot more that needs to be shaken out from that situation, but that could explain why the VIX has been such a dog this year, and not really as inherently useful as it generally is. But it also means I'm expecting to see a significant change in skew. So we'll have to see how that plays out. But it's something to think about, when you're looking at those skew levels. Alright, so we got the dollar here. You can see we're sitting up in the nosebleed sections. We're still challenging that 110. And there's really no reason for me to kind of step through everything that could possibly go through today. Because by the time Powell starts talking at 2:30, and then he gets done and they ask questions and they go through those motions, there's not going to be much left. And for someone like me who doesn't trade in power hour very often, that pretty much just takes the day off the table. So I'd rather start looking around at a lot of these other things and point you guys in the right direction towards what could benefit you over the next few days. So we've talked about the dollar constantly. It's not always an inverse product. It's not always something that we look at and say, oh, well, the dollar's going up, so I guess the market's going to go down. That's what it's been this year in large part, but that's not always the way it goes. And you can see that we're not sitting up at the tops. Around that 120 area is our next level of really significant resistance. We talk about ranges constantly and being able to measure a range. That 111.60, if we were to measure this range here, 111.60 is the halfway point. 100% of the range puts us up here from the .com era. If we put on something like fib running from the low to high from back there, you can see where we got tangled up on that 236. We're finally through that level. We're so far through this one, it would need to be moved at this point. Just kind of run it up. Now obviously these, it's a monthly chart. We're way out there, right? The kind of analysis that we would do on this high of a time frame, the results wouldn't be, what we're going to see in a day-to-day environment. Right, it's going to be more of the bigger picture. Right now, the target that I keep hearing is 115 in the dollar. That the 115 would be the next leg up before we start to consolidate, pause, kind of prove that it belongs there and that it's going to stick and keep it. Markets don't move in a straight line. Getting the 115 isn't going to be a straight shot. And then once we get there and we start to digest or, say, chop around, moving back between 115 and 110 is likely, right? And just like when we've been sitting here at the 110, we went through the 110 multiple times in the last 2 months. We just weren't getting into the 111 area, right? So when we get up to 115, it's going to be the same thing. It's not like it's going to stop on a dime at 115. But staying long the dollar or looking for new opportunities to go long in the dollar would be a good way to go. Now, every time I trade UUP, I seem to get assigned, right? Every time I trade options in that thing. So I quit trading the UUP. Now I use the smalls exchange if I want to trade the dollar. If you don't have an account at Tasty and you're not using the smalls, you wouldn't want to go get an account at Tasty just to trade those. I believe CQG offers that, and AMP maybe. Want to check. If you go to the Tasty Works or maybe the Smalls Exchange website, you can see what brokers offer it. But those new futures, they're great for hedging, and they're also great for getting access to things like the bonds. You can trade the 2-year yield, the 10, the 30. You can trade the dollar. So, and you don't have to worry about assignment. I love it. And no PDT, of course, because they're futures. They're just a different kind of futures. So they're absolutely worth looking into. I'm staying long the dollar, just kind of looking for new opportunities, especially when it makes that next leg up. It's the 30-year bonds. So I just mentioned the yields. on Tasty, if you were trading the 30-year, you wouldn't be trading the bond, you'd be trading the yields. So if you think interest rates are going to go up, you would buy, and if you thought interest rates were going to go down, you would sell. But we're not, looking at the ZB chart. It would be whatever Tasty's. They always have these funky little S values. It makes it really simple to be able to grasp what it is that you're trading. It doesn't run in fractional or nominal. Yeah, fractional values. Thank goodness we got past that. Right? Can you imagine having to trade S&P or NASDAQ futures using fractions? That would suck. Alright, so here's the index. We can't trade the index. We would have to trade the contract, which is why it's got a date on it and a letter designating what month of the year. But we use the index because it's a continuous contract. So if we were looking at these and wanting to trade, say, the 210 yield curve, or if you just wanted to trade the 10-year, which continues to expand drastically to the upside, you just come in and you want to go long, you buy it. You want to go short, you think interest rates are going to go down, you sell it. How simple is that? Right? So while everybody's trying to figure out, oh, should I go long Apple today? Should I go short Microsoft today? Where do I think Google's going to be in 2 days? Step out of the rat race and find something else to trade that has some consistency behind it, some forward thinking, and an actual trend. Right? When you think about trend, just to keep it as simple and streamlined as you can get, think about something like trends in society. Remember when everybody was running around in parachute pants and high tops? That was a trend. It lasted for a long time. It was obvious. Everybody could see it. That's a trend. Do the same thing in trading. If it isn't plain obvious slapping you across the face, it's probably not a trend or a long-term trend or a trend that's going to stick. Simple, easy. Yeah, I think I gave away my age with that one. I'm not old. Another one to watch out for is U.S. dollar Japan. They came out stomping their foot and saying they will not tolerate the Euro Japan going above 145, and we keep running up, challenging and bumping against that thing. We go to break above 145, we're likely to get a short squeeze like you wouldn't believe. Take off like a rocket ship. So just something to think about, right? Kind of stepping out of the same old stuff. 10-year at 4% or even 4.25%. I'm pretty sure that's a pretty good reference. Certainly something to think about. And if the 10 gets to 4 or 4.25%, where's that 2 going to be? All right, so that's why I'm bringing up something else to talk about, something else to look at, because with FOMC today, trying to walk through what we could see in the S&P or in the NASDAQ between now and 2 o'clock or now and 2:30. It's very likely going to be sideways, wicky, choppy. Be a good time to, say, go make some cookies or something like that. S&P, NASDAQ, Russell, and Dow, all underneath the 200, all underneath the 50, all showing that lower high, lower low, full set too, right? 2 higher highs, 2 higher lows. There's an expectation that we're kind of ready to, with linear regression, get another swing high. It's likely that we could bump against the bottom of that 50. And when you're talking 50s on a daily, you might want to look at both an EMA and an SMA. As I've demonstrated before, when you put them both on there, because there really are die-hard SMA people who will never use an EMA, and then there's die-hard EMA people who will never use an SMA, and their camps grow every day. So trying to just pick one or the other to see if we're going to hit something leaves you blind to the other one. So when it comes to the 50 and the 200, plotting them both, probably a good idea. Oh, I've seen earnings on here. Costco has earnings this week, and there's another one. ACN has earnings this week. I'm interested in what Costco has to say. I think the earnings itself isn't likely to reverberate throughout the marketplace, but what they say very likely could, especially when it comes to inventories and forward guidance. So kind of keep your eye on Costco. All right, I mentioned skew. The easiest way to kind of summarize what you would use this for is, does the market expect a big move? And I mean like a 2 standard deviation, really big move. If the market expects that, then skew goes up. If they don't expect that, or the likelihood of seeing a 2 standard deviation move, the expectations of seeing a 2 standard deviation move are really low, then skew will be low. And we use it for more than that, but that's just like the most generic kind of rubber stamp what skew kind of answer we could give. I don't know about you guys, but everybody that I've talked to is expecting some real fireworks today. There's an expectation that this market is really going to break this range and move, set a new leg higher or a new leg lower, but the guaranteed promise that we ain't staying here, it's on the table today. it's certainly not reflected in the skew. Got really low expectations of a big move, and that just doesn't make any sense, right? So when we think about Barclays and whoever, Goldman, getting caught with their fingers in the cookie jar playing with the VIX, if they manipulate the VIX, they manipulate a lot of things. We're sitting at record lows, by the way. I mean, sure, it's been lower than this, but only a few times in history, and I think you could probably count them up on one hand. All right, this is the move index. Think of this as like volatility for bonds. And it makes sense with the bonds continuing that move to the downside that volatility is increasing. Or we're kind of getting into a pretty significant level. It doesn't go back far. I've got it set for 20 years, and you can see it only goes back like 2 years. So it doesn't have more to offer than this. But we are getting up into kind of the highest point that we've seen in a while. I mention this because as sellers, it'd be a really good time to be selling. Sell things that are expensive. And you know, if they're not going to be manipulating the VIX, because now all eyes are on them, right? They're not going to try to manipulate things when everybody's staring at them. We could actually start to see the volatility pick up a little bit. So it might be worth throwing a little bit of money towards the VIX. If we think, you know, that the VIX right now is low. Alright, this is the VVIX. Think of this like implied volatility of the VIX. Right? If we were looking at a SPY chart and we wanted to know what the implied volatility was on SPY, we would just load the implied volatility indicator. Well, when you're looking at the VIX, you can't really do that. You can't load an implied volatility indicator on the VIX. That wouldn't make any sense. So they developed this, and it's basically the same thing. And this says that the volatility within the VIX is really, really low. Right? Again, not the lowest we've ever been, but some seriously low levels. We're all expecting a pretty rough earnings season. There is an expectation that volatility is likely to rise, especially if it's not being manipulated anymore. Right, this is stocks versus bonds. Stocks is the first word, so when you see this going up, stocks are doing better than bonds. When you see it going down, bonds are doing better than stocks. It's on a weekly basis, kind of going flat between last week and this week, which makes sense. Pointed just slightly higher. I think we've seen bonds go down a bit more this week, which means stocks going down less. But we are sitting at really high levels. This, just like anything else, is something you can throw trend lines on, look for divergence between this and, say, the regular S&P marketplace. momentum versus value. I'd say we're getting a breakout in momentum and that value's taking a backseat. Large caps versus small caps. When this is pointing down, the Russell's doing better than, say, the Dow or the S&P. The Russell was one of the first bubbles to pop, right? And mega cap was like the last bubble to pop. So it kind of makes sense that if we're ever going to be talking about, is the low in and are we making our way back up, that small caps are likely to lead the charge in that capacity. Big capital rotation is still going on. I mentioned it the other day with the market on close order hitting plus 500. That rotation from technology and energy and vice versa. When this is pointing down, energy is doing better than tech. When it's pointed up, tech is doing better than energy. We're still continuing to see a lot of short covering and short cover rallies. K-Web was moving around yesterday again, for an example. Speaking of things like that, casinos were lighting up in the last 10 days. A lot of call option flow and just flow across the board in casinos and airlines. Seen airlines starting to pop up last week. Their names still continue to hit my list through the day. Yesterday and on Monday. So certainly something to keep an eye on, be thinking about. It's a whole part of that capital rotation. And the ratio chart that I've often heard is one of the most important. I don't know if I necessarily agree with that, but I hear it constantly. Discretionary against staples. Think of it as fun money versus, household goods. Going out to eat rather than eating dinner at home kind of thing. It's not just that, but it's the easiest way to, put some words around it. So when this is pointing down, household goods are doing better than discretionary. Try not to look at it on a day-to-day basis. Look at the bigger trend, right? The week, the month. This help you kind of focus on, where's that rotation going, and where should you be? What sectors or what industries should you be focused on? All the boring, like energy, utilities, healthcare, staples, those are all generally things that we expect to do good in an environment like this. Alright, the 9-day VIX is sitting at a 30. And the 1-month VIX is sitting at a 27. So we are in backwardation between those two. The 3-month sitting at 27.88. So if you think about the curve, we're starting out high, coming down, and then beginning to move back up. That's your volatility curve right now. So definitely keep your eye on the front end of the volatility curve. Generally speaking, this is why I tend to watch the VIX futures more than just, say, the VIX. Come into the VIX futures, set it to single, show all. It tells you the active contract, so we're on the October 22s. That's at $27. Come out to the November, it'll show you, see how there's multiple Novembers. Just look to see which one's getting traded or has volume. So going from 27.01, 27.06, 27.07, and then it starts to get a little higher. What this is telling us in here, right now, this is your volatility curve, and then it slightly goes up when you get into next year. This is so very dangerous. If this is where we are, and then you've got, say October, November, December is just flat, we can get into some really nasty backwardation today. This is going to affect things all across the board. This is the sizzle in the SPX. They already got rid of the sizzle values from yesterday, but what is still here is the volume from yesterday. Now the average daily volume across all options in the options marketplace is generally hitting around 50 million a day. I think that's the number, like 42 to 50 million. So volume is light. Remember, if this is going to be a bottom, if we do get a rally today and we start to run up, you're going to want to see across the board buying in options, right? Not just like, you don't want to just see Apple run. You want to see Apple, Microsoft, Google, Tesla. Sizzle is 5-day average. So if you want to see the 5-day average of the call and put sizzle combined, you look at the sizzle index. Anything above a 1.0 means we're above the 5-day average. gotta give this one a second. It's got a lot of data. Come on, you can do it. Probably should have broke it down into different charts. Anyways, you can lay out the options volume in every name out there, right? So right now, this chart is Apple. It's got this Friday's expiration, October 1's expiration, has the month, right? That OPEX for October, and then it has a combination of October, November, December with the OPEX. I took some pictures of this over the weekend, was writing up an article on it. The main takeaway was, especially on Friday when we got some reasonably decent volume and there was talk of, oh, well, we gapped down, we rallied back up, we had the volume there, maybe this is a short-term low. And, you know, there's an argument that says, no, we didn't have all of the other things that we would expect to see if that was going to be our bottom and our low. I think I got something wrong with it. I gotta fix it. Anyways, take a look at Tasty if you want to think about the yields or getting into the dollar. Give today its space. You know, if you want to go fishing or just literally get the heck out of the office and go do something else, it's not a bad idea. But be thinking about what you're going to do between now and, say, November, the next FOMC meeting. Even on the options trades, if you're going to get into swings or anything like that, have that same thing in mind. Be thinking about it between now and then. Ford took a punch yesterday. I have a swing in this. Was selling puts to get stock. Well, I got some stock, all right. The cost of their supply chain is what they gave an announcement on. And they said this is a little bit of a bellwether that a lot of other automakers are going to be sitting in the same boat. So I did take possession of 100 shares. One of those puts was assigned. I ended up selling another put around $13, and then I rolled one of my existing puts out in time. So now I've got two January puts, one at 16.5, one at 13. Got 100 shares of stock. I'm not yet selling a call. Really no rush on the call sell, and since we did drop down so drastically, there is a little bit of whiplash effect that I'm kind of waiting on. It's not necessarily that I think Ford's going to rally back up right away. It's the idea that after dropping so far, we're very likely going to bounce back at least 50% of that big candle. So I don't want to sell a call and then get ran over, right? So this Ford one is going to end up being a great teaching moment using the roll feature, fixing one of my short options, my 16.5 short option. I rolled it out in time. I kept the same strike. I just moved it into January, and I collected another $25 for it. That makes perfect sense because I put it farther out in time. Time's worth money, and they gave me some money for it. Right, so it's the same position that I already had. I just have more money on it. It still needs to be fixed, and now that I've rolled it out to January, I've got more time. Basically, looking for this to begin some recovery. If it doesn't, it's fine. I can still work with what I got. But if we began to rally back up, that January put is something that I could very likely roll again. And now that I've collected more credit on it, if I did have to pay a little bit of a debit in the roll, to get a better position, I would just be giving back the credit that I got for the roll. Right? So sure, you have to pay a debit to make the roll, but I'm just paying them back their own money. Right? So in the end, I think it'll be a great teaching moment. Eventually, I want stock in this anyways. That's the goal, to accumulate Ford stock. Everybody, be careful, be safe, have a good one, and I will see you all tomorrow in a whole new world, right? Because I think by tomorrow morning we're going to be in a completely different market.